Despite ongoing projections of additional interest rate increases by the Federal Reserve this year, investors are still concerned about rising long-term bond yields, which continue to keep borrowing costs high for U.S. consumers and businesses. Let's go to Blake Gwinn on this. He's head of U.S. rate strategy, RBC Capital Markets. Thanks for joining us today.
Thanks for having me.
So much has been made, of course, of the 10-year record of staying above 4%. But could you explain how this is keeping borrowing costs high for American businesses and consumers?
Yeah, I mean, we've seen a very range-bound environment for the long end. Despite the Fed's cuts that they delivered. I do always kind of caution, though. Those long end yields do already price in those expectations. So the fact that the Fed actually delivered on those cuts, markets had been expecting those. Those have already been baked into some of those longer-term yields for a while. So I don't know that we necessarily expected a drop in the 10-year yield on those cuts. Now, if they had not delivered what was priced, if the Fed, had decided not to cut, even though the markets were pricing it, then we might have seen, yields move a bit more. But they've been very range bound as the expected terminal rate for the Fed has been very, very pinned, even though we've kind of shifted around the timing of some of the cuts that we got.
Okay, let's talk about Donald Trump ordering mortgage bond purchases to reduce rate costs and, of course, provide some stimulation for housing. Does that work? Is that effective?
It's probably going to have some effect. This idea was, to the best of my knowledge, first proposed by a group of lobbyists last year. They had mentioned this letter that had been sent to the administration had mentioned that if they were to do $300 billion, I think, in MBS purchases, that you could get something like 30 basis points difference in mortgage rates. This was obviously a bit smaller at $200 billion, so I would expect the impact to also be a bit smaller. So, you're maybe talking something in the neighborhood of 10 to 20 basis points in terms of mortgage rates. I think that's a perfectly fine expectation. But is that really going to change the mechanics of, who's buying a house? Is it going to affect that decision of whether or not I'm taking on a mortgage? I don't know if a 10 to 20 basis point swing in that mortgage rate is really having a major impact. But they're trying a lot of things. I think, they're clearly very focused on this affordability issue right now. They're kind of throwing everything at the wall to see what sticks. There were several other announcements that came along with that where they've, over the last few weeks, where they're clearly trying to do something about housing and home affordability.
Okay, let's talk about Treasury Secretary Scott Bessent attributed the bond and equity sell-off yesterday to rising rates in Japan. But was there more to it in your mind?
I think that was definitely a part of it. I think there was kind of a hodgepodge of factors. I think the sell-off really started Friday of last week. We got some headlines about the possibility of Warsh as a Fed chair rather than Hassett. I think Hassett has been kind of the odds-on favorite. Some comments from the administration started to turn that around. I think, you could kind of say, well, why did Warsh mean higher yields, steeper curves? I think there is this view that, perhaps he's a bit more credible than Hassett. That could have been driving some of it. So you're not going to get these kind of you're not going to get the kind of dovish outcomes that you might get under a Hassett. He's a little bit more independent. I think the other piece of it is, in the past, he has been a bit more hawkish on balance sheet policy. So I think there's a view out there, not necessarily mine, but I do think there's a view out there that Hassett could theoretically deliver a more hawkish balance sheet policy. So, restarting QT, maybe even doing bond sales, something like that. Now, again, I think that's a bit far-fetched, but I think that's what really got the move going. Then as we got into this week, when the U.S. markets were out on Monday for the holiday, we saw a lot of movement in Japanese yields. That certainly added to it. And then lastly, I would say, a lot of the concern around these Greenland headlines, that started to move equities. And we saw kind of a classic risk-off move, which was further pushing yields up. So I think it was kind of all of those things. And I would say the volatility itself, the fact that yields had moved so much on Friday and then into that Tuesday session, that also started to challenge some of this very range-bound, low-conviction, low-vol type of environment. A lot of people have been putting on trades focused on carry because of those things. When you start seeing a little bit of vol, you may see some pullback in that carry-based positioning as well. So that also probably added to it as well.
How much does perception of the new chair sort of matter when you're taking into account what comes? Because it feels like how that person is seen as opposed to what their history is sometimes matters more.
Yeah, that's really something I've been very focused on, and I've been kind of stressing to clients. This is a one-person switch on a 12-person committee. There's no guarantee that one person, even if it is the chair, can really pull the committee to policies that the rest of the body doesn't really agree with. So to think that either Hassett or Warsh, or even now, we're seeing some other candidates, Reader, kind of coming up. Those odds have risen quite a bit over the last 24 hours. I don't know that the actual policy outcomes, whether it's in terms of rate policy or the balance sheet, are really going to be materially different under either of those candidates over the next 1 to 2 years. Because, again, that's one person on a 12-person body. Now, what I will say from a trading perspective, it does seem like markets will kind of latch on to the idea that there is a trade around each of these candidates. So, I mentioned before that people are kind of seeing Warsh as hawkish on the balance sheet. So, what do? You steep it, you go into curve steepeners, you sell, treasury swap spreads. People have decided that's kind of the trade for Warsh. So if you see his odds go up, that's the trades you do. Now, that may not actually play out. In the next 2 years, however long their Fed chair, maybe it's not actually a different outcome, but if the market decides that's how it's going to trade, it's very, very tough to fight, to fight that direction.
Blake, Gwinn, got to leave it there, but thank you for your time. I appreciate you joining us on The Close.